Ladies and gentlemen, I am Deanne and I will be your host for the session today. Good evening and welcome to the WebEx session, How to Set Up a Cryptocurrency Exchange in India. The session will be presented by my colleagues Vaibhav Parikh, Meyyappan N and Jaideep Reddy, and external speaker Mike Patel. Please note that this session will be in listen-only mode and will last for about 60 minutes, of which first 30 to 40 minutes will be spent on panel discussion. The remaining time will be available for question and answers. Requesting all the participants to be on mute mode for the session. You can post your questions in the chat window while the panel discussion is on. The moderator will queue up the questions for the speakers accordingly. Should you need any assistance during the conference call, you can use the chat option. Do note that this conference is being recorded. I now welcome our session presenters, Vaibhav Parikh, co-head TMT practice, and also heads our US operations. Other panelists are Mike Patel, founder, Lakshmi Crypto Exchange, and EU licensed Estonian entity. Meyyappan Nagpar, leader, Tech and Tax Practice Group, Nishith Desai Associates. Jaideep Reddy, leader, Crypto Asset and Blockchain Practice. Over to you, Weber.
Thank you, Diane, and thank you everyone for participating. As Diane mentioned, if you have a question, please put on chat window as soon as you get the question. We will address it in the end of the session, but if you wait till end of the session, then we may not get time to answer your question. With that, let me start setting up the tone for our session today, our event today. We are going to talk about setting up of a virtual currency exchange or cryptocurrency exchange in India, and what are the challenges, issues, and what it takes to do it. We'll also address the tax issues to some extent, and Mike Patel will give his view or his experience on running the exchange, and so that's the whole discussion on today. As I don't know if some of you attended our previous session on cryptocurrency, where we analyzed the Supreme Court judgment with IMAI. This is a runoff from there. If you have not attended, you should watch our video of the session, recording of the session. It will help you. In that session, we did say that, look, we ended up getting into cryptocurrency space in 2013, thanks to my colleague Nishith Desai, who identified cryptocurrency as a very unique and interesting technology and with great potential. We started looking at it at that point of time, and as I discussed, we kind of helped the whole industry. We went and saw different challenges which the exchanges had with the regulators, with other agencies, and we kind of helped them in trying to work around or really face the challenges. It was a tough time for them at that point in time, but slowly things started settling down. But then there are always some bad players, and we had a lot of situation with some bad players who tried to take advantage of people's ignorance and people's and tried to become greedy by doing Ponzi scheme, and that got regulators into back foot position to a level where Reserve Bank of India at one point in time had just declared it as a warning, then came and put a virtual ban by preventing the banks to do business with the any company or any individual which deals with cryptocurrency. As you know, we fought the RBI ban in Supreme Court, and after 2 years, we kind of won. We got circular set aside. Now, Since circular is set aside, technically the doors are open for setting it up. So today we will discuss, what is the situation after the circular is set aside, and what challenges do we still face, and what it takes to set virtual currency exchange in India. With this, let me first go to Jaideep and ask him to give current legal position on crypto assets, especially in light of Supreme Court judgment, and if you can also give key takeaways for exchanges, virtual currency exchanges from the Supreme Court judgment. Over to you, Jaideep.
Thanks, Vaibhav, and thanks everyone for joining. Should be an interesting session. So, taking off from where Vaibhav left off, the Supreme Court judgment is really the second piece of official lawmaking we have on specifically on crypto assets in India. The first one being the Rbi Circular. I'll just briefly describe what was the impact of the Rbi Circular. Because of the Rbi Circular prohibiting any bank or other regulated entity from facilitating any cryptocurrency transaction. In other words, nobody could buy or sell cryptocurrency through a bank account. That was the instruction to banks. Because of that, the exchanges in India were forced to either close business or try and experiment with alternative models, some of whose legality was in a gray zone. But in essence, it made it very difficult or nearly impossible to operate. In the words of the Supreme Court, the lifeline of the exchanges was disconnected, sending them into comatose. So strong words from the Supreme Court. What the Supreme Court ultimately found was the circular was a disproportionate restriction on the fundamental rights of the exchange founders. Because, as many would be aware, all citizens of India have a fundamental right to trade freely in legitimate businesses. And cryptocurrency was a business which was a legal business. It was not declared illegal. And the court found that the restriction on banks and other regulated entities, which effectively severed the lifeline from the industry, was disproportionate. In other words, it was an unreasonable restriction by the RBI. Having said that, while that is the main takeaway and the primary point to keep in mind in law, the Supreme Court made many observations which are interesting and would have an impact going forward. It's a 180-page judgment, and the court got into the legal character of crypto assets because it needed to decide whether the RBI had jurisdiction over the phenomenon. And what it concluded was the RBI did have jurisdiction over the phenomenon. The reason for that was the court found that crypto assets have several of the features of money or currency, though they do not satisfy the existing legal definitions of money or currency under various laws, including the RBI Act as well as the Foreign Exchange Management Act. The court noted that there were 4 features of money. For something to be money, it would be a unit of account, a store of value, a means of exchange, and a 4th feature was whether it's socially accepted as money. And while one of the petitioners argued that because cryptocurrency is not socially accepted as money, it's not money, the court found that even satisfying three of those characteristics was enough to give it the color of money, or so-called fake as a currency. When the court used the word fake, it didn't mean counterfeit, but it meant playing the role of a currency. Therefore, this may have implications which my colleague Meyyappan will discuss from a tax perspective, as well as from other perspectives like FEMA, foreign investment, etc., where prior to this judgment, while one could have argued that this is only an intangible product or in the nature of something like IP or software, while that argument can still be taken, one has to keep in mind that the court found that RBI had jurisdiction because this was in the nature of money. Having said that, the court also found that, also observed that this was an intangible property. That was an expression it used, and it said that while this may not be just goods um, or a commodity, it may also amount to money. So interestingly, the court has recognized a dual feature of cryptocurrency, which could have various implications from a tax and regulatory perspective. Interestingly, the court referred to the Vedas, where it referred to a saying called neti neti, which is neither this nor that. And the court found that cryptocurrency is one of those phenomena which are neither here nor there when you try and pin it down, which makes our work very interesting, but also presents obviously a lot of challenges and gray areas, both for industry players as well as regulators. Now, one of the practical takeaways is, as Vaibhav said, the doors are technically open because there's no restriction in law for a bank to provide an account or facilitate crypto transactions. But what we have come to understand is that several banks are still conservative about facilitating these transactions because the RBI has not clarified after the judgment that banks may freely facilitate these transactions. So while that is not required in law, the fact in law is that the judgment itself is sufficient for a bank to provide an account subject to its KYC and AML satisfaction. That is one factor that several players in the industry are dealing with, and that challenge will continue to evolve until we have some further developments. So with that, I'll actually pass it over to Meyyappan, who will discuss some of the tax implications arising post-judgment. Over to you, Meyyappan.
Thanks, Jaideep. So I think I have he set the stage for the tax analysis to follow. From a tax perspective, I'll quickly be covering several points under the Income Tax Act, under GST laws, and also under some highlight some new taxes that have been imposed under the recent Finance Act 2020. So to start off with, under Income Tax Act, the first sort of broad classification that could potentially arise is whether the trading in cryptocurrency is a business income or a capital gain sort of a transaction. So if there are circulars in the past which have dealt with how the transaction and shares are to be categorized. So if it's a regular trading conducted by the entity, it's more likely to be classified as business income. If it's a one-off transaction, there are arguments to say that it should be a capital gain transaction. Now, the second issue that could arise is if sometimes these currencies are earned through mining activities. So in such instances, when freshly mined coins are traded, the question could also arise, what is the cost of acquisition in that case when it's a capital gain transaction? So these are some unresolved issues which may come up in the forefront later. The second thing is under GST laws, as Jaideep correctly said, I think the court has observed that the cryptocurrencies typically reflect 3 out of 4 requirements to be categorized as money. But why it's important from a GST perspective is that GST is applicable on all movable property or supply of movable property, which constitutes goods other than money, right? So whether is it a good or a money is an important categorization from a GST perspective. If it is categorized as money, then GST should not be applicable. However, if it is categorized as an intangible property or a good, in that case, it's likely that a 18% GST may be applicable on those sort of supplies. Now, again, to add more nuances to this, if many people in the industry, many participants are probably casual traders, they don't do this as a business. So there are clauses in the GST Act which say that for it to be a taxable supply, it has to be in furtherance of business. So there are arguments to say that some of these supplies are probably not subject to GST if a casual trader is involved in them. And also another issue that can come up, and we'll get into this in a bit more detail when we are talking about specific models later in the webinar. But of course, if there is a transaction where it's not just fiat to crypto, but crypto to crypto, it could be categorized as a barter as well for GST purposes, and which has a higher sort of a GST outflow in that situation. One other point that also comes up, which is important for GST, which directly derives from the observations of the Supreme Court, is that there is parts of the Supreme Court judgment state that a cryptocurrency is not something that has a specified location, and only the private key has a specified location in many cases. So when it comes to GST, there are a lot of rules around whether it's a cross-border transaction, whether it's an intra-state supply, interstate supply, and for all of that, it typically revolves around where is the good located and where is it moved from, and what is the starting point, what is the end point. So there could be doubts as to how those rules are applied in practice. Of course, from our perspective, maybe it makes sense to align all of this and say that the crypto asset should be deemed to be where the person is located who owns it or is using it at that point in time. So that could have implications on how these transactions are categorized and taxed under GST laws as well. Now, quickly coming to two of the new provisions that have been inserted. Again, one will be the equalization levy. Now, this is a 2% tax that has been imposed on a non-resident platform owner or operator for any transactions undertaken by them over the internet for Indian resident people. So, for instance, if they are, let's say, facilitating trades between people and it's a foreign platform and one of the parties is an Indian party, the equalization levy would apply. It's a 2% tax that the platform owner or operator will have to pay on the consideration received by them. There is one more new obligation imposed under the Finance Act, which is the obligation to deduct tax at source under Section 194(0). Now, what this talks about is basically that the same platform owner or operator, and for this case, for 194(0), it doesn't matter whether they are offshore or onshore. To make a distinction, the equalization levy I referred to applies only to offshore operators, whereas the tax deduction on source that I'm talking about now applies to operators who are in India as well. But the defining criteria is that the sale that they are enabling has to be in respect of an Indian resident seller. So if an Indian resident seller is selling a Bitcoin either through an online or either through offshore or onshore platform, then 1% of the gross value of the transaction has to be withheld and paid to the tax authorities as tax deduction at source. This tax is obviously paid on behalf of the seller. But again, later in the webinar, we'll get into how there could be cash flow issues and there could be other problems on how on what value is the 1% and 2% calculated is something that I'll be providing examples later. But before we get into that, since Vaibhav has worked on several cryptocurrency exchange matters, Vaibhav, maybe you can tell us what are the different models that are followed by cryptocurrency exchanges in India and what are the best practices followed by them?
Thanks, Meyyappan. Before I get and answer Meyyappan's question, I just thought to let participants know that we got a lot of questions on where we can find your previous session. Previous sessions are, some of the previous sessions there are on our website. Some of them are still not there. They will be put in as soon as possible. But if somebody is interested, you can go and look at all of our sessions, what we did till now. And if you need a specific one which is not there on our website, then please reach out to us. As far as the specific one on the Supreme Court judgment, Jaideep, my colleague Jaideep, has actually already put in the chat window the link. It can be accessed through a website on Nishith.tv site. And if you're not on chat window, then just you can reach out and we'll send you the link. Or you can just try using our website to access it. With this, let me come back to the question. I think the question you asked was, what are different models which have been used in India? And what are the best practices? So basically, when I look at the different models, the way, if I summarize, I mean, things developed over a period of time. It started with the OTC model, what you call over-the-counter exchange, where the parties actually bought and sold cryptocurrencies, right? So which means that you want to set up a company, and company was counterparty to each deal which happened. So they bought on one side and then they sold on the other side, and that was a model with which the whole business started with, a very popular model at that point in time. And then that led to a model on marketplace model, where instead of being counterparty on each transaction, on the marketplace side, they ended up looking at just being the facilitator, where they basically listed the buyers and the sellers, and they matched the buyers and sellers, but then they still acted as intermediary for concluding the transaction. So this is very similar to how the e-commerce website works. And this today, at one point of time, was very popular before the Supreme Court, before the Reserve Bank of India actually put a virtual ban on the currency business. Then we saw another model come up, what you call P2P model, where the exchanges did not facilitate the payment, but they, just like how brokers work, they connected the buyer and the seller, and the buyer and seller actually did the deal, giving the exchanges some kind of commission, but the fulfillment was done directly between buyer and seller. The exchanges did not participate in the fulfillment aspect. And then again, the way things worked was in these three exchanges, especially in the second and the third model, you had a situation where you could actually do fiat to fiat, which means that fiat to crypto, which means that one would buy in cash and sell in cash, which is Indian rupees. Also, the fee to the exchanges was paid in cash. So that was what fiat to crypto was. And once the virtual ban came in, then it became more likely crypto to crypto trading, which means that instead of buying in cash, people ended up doing a barter, where they sold one kind of cryptocurrency with other kind of cryptocurrency, and also any fee was paid in cryptocurrency rather than in terms of fiat currency. So this is basically how the model kind of evolved in Indian industry. Coming back to the point where setting up of virtual currency exchanges, the virtual currency exchanges is not regulated, and hence does not require a license. So it is not that, I want to set up a virtual currency, so who will give me the license? There is no regulatory authority who will give you the license. You can simply set up a virtual currency exchange as of today. Now, the point is that when you have no regulator, and it is in a sensitive situation where regulators are not looking at this sector very favorably, the onus actually comes on you, not just to make sure that you don't violate any laws. And again, keep in mind that just because you don't require a license doesn't mean that you don't require to comply with the laws. There are a lot of laws which you need to comply with, and not just you need to comply with laws. In our view, you need to go beyond compliance with law and have best practices, so that you ensure that in case regulators reach out to you, you can be a good citizen. What we found over a period of our last few years of experience, there were at least 3 specific aspects where we strongly insisted the exchanges to follow certain best practices, which would also mean that it will be in compliance with the law to the extent possible. And those three were, one was having a good KYC for people who would do buying and selling on the virtual currency exchange. Now, if you know, one of the key items and the key worry which regulators have is Bitcoins are anonymous in nature. Now, what I mean is that while Bitcoins can be tracked, it can be tracked to the wallets, but who owns the wallet cannot be tracked, right? So if regulator wants to track, for example, who is doing buying and selling or who is using a cryptocurrency for illegal items, then they can reach out to the wallet. But if they don't know who owns the wallet, then they will hit a wall, and that will anger the regulatory agencies, right, to come very heavily against cryptocurrencies. So one of the things which we suggested is that make sure you have a KYC which clearly complies with the money laundering regulations and all the other relevant regulations. So tomorrow, if anything comes up, you can go and say that, hey, it is just the wallet to which you can track, but you can go beyond wallet and you can link it to the person who actually has traded the particular cryptocurrency. It is a person behind that particular wallet. So that KYC is very important. Also ensuring that your terms and conditions and your agreement with the consumers are very clear, which allows you to not just collect the KYC information, but also share it with the government, so that you can say that, look, we are doing, while we are trying to protect the privacy of a particular user, in a situation where there is a ask by the authorities, we will be in a position to give it to them. So getting the right terms and terms and conditions and agreements with the user is very critical. Also very important that to protect yourself, you put enough disclaimers and enough conditions where they can't use it for illegal purposes, and they can't really use to do something which can cause basically which can cause liability to exchange, right? So you try to minimize the risk assessment, risk aspect of liability when it comes to any action of the user or the customer. So this is something which is important. The other thing which we strongly recommended is no cash. Often cash leads to difficulty in determining how the cash was obtained, and that can trigger a lot of AML and other concerns. So in addition to KYC, we strongly recommended people just to use banking transactions and not use any cash. Now this actually became a little bit of problem, because when Reserve Bank of India actually asked bank not to deal with them, the whole virtual currency exchanges who were basically not taking cash suddenly had a maximum hit compared to currencies if they had actually accepted cash. Even in that situation, we were very clear that, look, it is not advisable to take cash, because that can lead you to bigger problems later on, which may be worse than fighting Reserve Bank of India on getting the banking access. And the third aspect which we strongly recommended was to just stick to domestic transactions, rather than getting into domestic to non-domestic or foreign transactions. Cross-border transactions are a lot more tricky and have a lot more issues, and may not be in regulatory compliance. So that's the other thing which we advise as best practices. This is just few of the best practices which we thought, and not the full list, but we just thought we will mention the few critical ones, and we can answer it later if anyone has a question on one-on-one basis. But with this model, let me come back to Meyyappan and ask him that basically what are direct tax and indirect tax implication based on these models, right? What do you think we should be, users should be knowing about it?
Thanks, Vaibhav. So I think on the three models you had mentioned, marketplace, P2P, and OTC, I'm going to slowly go through the different tax implications, and I'm going to give a couple of examples to illustrate how the new equalization levy and the new tax deducted at source under 194O will have some impact. So in the marketplace model, right, we have the company, the platform enabling trades between two participants. One question that can arise, and assuming it's a foreign platform, they would be subject to the equalization levy, because assuming that one of the participants is from India, a 2% levy would have to be paid by them on whatever consideration that they receive for facilitating the supply of goods or services through their platform. That's how the section is worded. So one question that can arise is, on what consideration will the tax be payable, right? So to give you an example, let's say that a person A is selling to person B a crypto worth 100 rupees, and 10 rupees is the platform fees in that case. So ideally, the platform fees of 10 rupees should be subject to the 2% deduction. But sometimes it is possible that if the sale price, let's say the agreement between the parties is structured in such a way that the value of this sale is 110 in the hands of the buyer, and in the back end the seller pays 10 rupees to the platform. In that case, the value of supply becomes 110 and not 10 rupees. So the value of supply facilitated by the platform is not 10 rupees and 110 instead. So what ends up happening is that you end up taking a bigger hit, which is you're paying 2% on 110. And when you're operating on smaller margins and you're relying on large volume, even a 2% levy would have in itself been very difficult to justify. On top of it, if the exchanges are expected to pay on the total value of the transaction, that's going to be a pretty big hit. So that's one planning point for exchanges to review their models and probably restructure the contracts to mitigate this risk. The second thing is, again, from a GST perspective, the GST would be applicable on the service fees. There, it's an easier argument to make it's only on the 10 and not on the 110 as the consideration value. But on 194O, which is the new tax deduction at source. Now, this is a tax that has to be deducted on behalf of the Indian resident seller by the platform. So on the 100 rupees, ideally you would have deducted 1 rupee. But then again, as I was saying in the earlier example, if the supply value is 110, so then you're deducting 1% on 110 and you are paying it to the government on behalf of the seller. Now, where in a marketplace model, if typically the money is flowing through the marketplace, that is less of a difficulty for them to withhold the money and then pay the seller. But that's where the major difference comes in the analysis between a P2P model and a marketplace model. So in a P2P model, the money doesn't flow through the marketplace. That's one of the distinguishing features when you compare it with the marketplace model. But there is a specific proviso, there is a deeming fiction under the new tax deduction at source rules, which says that even if the money doesn't flow through the marketplace, it is deemed that the money flows through the marketplace, and therefore the marketplace has to withhold 1% on those transactions. So which at some level make absolutely no sense to me, because if the money is not flowing through the platform, how would they practically enforce this, or where will they go for the money is an open question at this stage. So that could be a significant pain point for P2P models under the new regime. Even under the and when we put an added twist to this, if we were to take a crypto to crypto sort of a situation where there could also be further complications, because in any case, if the marketplace is also being paid in terms of crypto and not in fiat, there are models where the commission or the fees charged by the exchange is in terms of cryptocurrency. In that sort of a situation, also, I think cash flows could become a potential challenge when discharging these TDS obligations and taxes. Coming to the OTC model, of course, again, as I had earlier said, because the platform is buying and selling in their own name, it is likely that, I mean, it could be categorized as capital gains or business income. More likely it is to be business income in this case from an income tax perspective. There would also be a GST sort of impact in the OTC model, which is different from the P2P or marketplace model, because in the, as I said, in the marketplace or P2P model, the GST is only on the service fee element. Whereas in the OTC model, because the supply itself is of the cryptocurrency on a principal to principal basis, there will be a 18% GST when the platform supplies the crypto to a buyer. But but on the buys that is made by the platform, there could be a GST, and there are situations where there may not be a GST. So if the seller from whom the platform buys is somebody who's doing it as in furtherance of his business, then the transaction becomes subject to GST. And while the platform pays GST on that transaction, they'll also get a credit of it to set off when they further sell it in the future. But if they are buying it from someone, like I said, who's a casual trader, someone who's doing it as a hobby, it's possible that that transaction is not in the furtherance or course of business and therefore not subject to GST, in which case, while GST is not applicable, at the same time, you don't get any credit to set off for future supplies. So in a way, that kind of maybe cancels each other out. Coming to specifically to crypto sort of trades, as I had mentioned, one issue could be that from an income tax perspective and from a GST perspective also is valuation. Valuation in terms of when you are exchanging crypto to crypto, what would be the value on which for each crypto exchange, and how would that be the tax base for charging the 18% tax or calculating your income or loss position will be a tricky thing, because there are many times when there are different sort of rates all around the world for these kind of different currencies at the same time. So which price do you factor into account at what point in time? Sometimes they are not the most liquid as well. So that could be one potential issue. Second, again, for cost of acquisition is something I had mentioned earlier, and it would be considered a barter transaction from a GST perspective. So there is potentially a significant tax outflow there, where there is a 18% applicable on both the supplies, meaning when a person exchanges crypto with another person, there are two supplies there, not just one. So there could be 18% on the value of both the crypto that is exchanged speaking. So these are all broadly the different issues that come up. Of course, there is not much clarity from the tax department on several of these aspects. And as Vaibhav was saying, of course, there are a lot more nuances and several other questions that can arise. But we have tried to summarize the most key points that are more likely to come up basis the findings of the Supreme Court in this case. Now, having said that, I think like Jaideep to say a few words on the laws surrounding foreign investments into crypto exchanges in India, and whether that will be impacted by the ruling in this case.
Sure. Thanks, Meyyappan. I see the questions are flooding in, so I'll try and be as brief as possible so that we have as much time as feasible. The aspect on foreign investment which is interesting is that prior to the judgment, one could take a view that the crypto exchanges were essentially e-commerce marketplaces under which foreign investment is permitted under the 100% automatic route. If they were trading themselves, then that became questionable again on whether it was inventory or not. But under the marketplace model, foreign investment is freely permitted, and that was the model that most exchanges were following. One implication of the judgment is that when it recognizes the RBI's jurisdiction over this space, whether that transforms it to a financial services activity. And financial services is treated differently for FDI purposes, foreign direct investment purposes, where many types of financial services are subject to government approval. Even under the other financial services category, which is under the automatic route, um, where the regulatory purview is not clear, it specifies that government approval would be required. So I'll keep it to that for now. What is definitely going to be interesting is how this plays out in the sense of foreign investment and exchanges, what views can be taken. But that is one issue thrown open by the judgment. With that, I'm pleased to hand it over to Mike Patel, who's an Indian entrepreneur who started a crypto exchange which is duly licensed in Estonia as under an EU license. And Mike, if you can share your experience as a crypto entrepreneur with the
audience. Sure. Is my audio pretty clear?
Yes.
Great. Thank you, Jaideep, for the opportunity. So basically, the experience was pretty crazy for us because in 2017, when I relocated to Prague, we were initially building a software which provides market making and liquidity to all existing exchanges, which did not require any licenses whatsoever. And then we realized that if we are able to do any kind of custodian or any entity or any retail dealings, we will definitely have to acquire a license. So we applied with FIU in actually 4 countries, in Switzerland, Germany, Czech Republic, and in Estonia. FIU is like a financial intelligence unit. Almost every country in Europe has their own FIU arm. And Switzerland has something called FINMA, UK has FCA, and Germany has BaFin. So we applied with all of them. Thankfully, the Estonia license came much faster. And we are actually now also in the process of getting the clearance and the licenses from FINMA in Switzerland and also FCA registration in UK. But the process was very confusing for us because most of the law firms based in Europe themselves were not aware about how this plays out and what kind of licenses one needs to require or acquire, what is needed to have a payment processing platform or fiat on-ramp on the platform as well. And we are already dealing with institutional clients. We provide liquidity globally now. So it was a very, very tough learning curve from 2017 to 2018 last quarter. But there was a lot of clarity in 2019. And I think all the government agencies are now also become very straightforward that if you're not domiciled and if you're not based out of Europe and if you're an Indian entrepreneur just coming to get a license and going back, they don't look at that in a good light anymore. Most of the licenses of that nature have already been cancelled. And they want to make sure that you are domiciled in one of the country where you either plan to acquire the license from or from where you will be operating as business. And that's very clear. We understood after meeting almost all 6 or 7 regulatory heads in almost 5 countries. So that was very, very straightforward. And I think the bigger advantage was that we interface with the regulators directly, whether it's FINMA, FIU, of course, along with our law firms and along with our lawyers. But there was not a single instance or a point where they wanted to meet one of the promoters and we were not available. So I think that really builds a lot of trust factor with them, that you are constantly in interaction with them. You are based physically here and you are constantly showing your face to them and explaining them at each stage, what are you developing now, what stage are you in. And what now the new rules have changed is that you cannot actually open an exchange or onboard a single customer without a license. Especially UK and Europe has completely changed that compared to 2017 and 18. Which means if anybody has onboarded already few clients, even if they processed self-governance, AML, 5D or KYC laws, they will still be looked down upon as an irregular or illegal activity. And they will be told to freeze all the activity and start from scratch. So it's pretty confusing for a lot of big exchanges who are operating in Europe for last 2-3 years and they still don't have any license. It's it looks like they will not be able to get any license anymore unless they really start from scratch. So that's a big challenge. But I think the good part is that regulatory heads or agencies have much more clarity today than when we started in 2017. And they are actually very cooperative, very open to help you out as long as you are not pulling a scam. Like Vaibhav said, unfortunately, India had bad actors. And I think that was one of the main reason the whole crackdown of BitConnect and Gain Bitcoins, which created a few thousand crore scam in India and all over the world, unfortunately brought a lot of bad name to our country. And I think RBI had no other option but to close everything down to protect investors who have no idea what they are putting their money into. And Vaibhav, just one more small thing, what we are learning now, so sharing with you that they are also now differentiating cryptocurrency and virtual currency. Cryptocurrency is what we are doing, Bitcoin, Ethereum, top 150 currencies, all of that. And they are actually now slotting virtual currency into something which is being used in game for buying things within a game, or whether they are entertainment focused games, whether they are gambling games. So they are now trying to create a further definition that if you are using the word virtual currency, then you are not a cryptocurrency business, but you are creating tokens to be exchanged, bought and sold for a in-game activity. And this has come through in Switzerland and also in Germany in the last few months. Very interesting. But to be honest, Jaideep, that was more or less our journey. There was a lot of learning. We also got misguided a lot in the first two stages. But thankfully now I think it's pretty good and we are in a very, very healthy and happier shape and a much stable situation as well.
Thank you.
Thanks a lot.
Thank you, Mike. With this, I think we will go to Q&A. We have got about 40 to 50 questions. There is no way we'll be able to answer all of them. What we will try to do, again, some of the questions came and we have already addressed them during our sessions. Some of the questions are very specific ones, which I request people to kind of get in touch with us offline, and we can try to address them on an offline basis. We will try to give priority to questions which relates to setting up of virtual exchange. And then there are other questions which are relating to cryptocurrency, but which goes beyond virtual exchange. We will try to see, what kind of how much we can address that, right? So that's the way we are trying to kind of do it. Mike, I think you made a very important point with differentiating cryptocurrency and virtual currency. I think in India, Reserve Bank of India is using the word virtual currency, and I think they are currently just doing as a substitution of cryptocurrency. There is no such differentiation which India has yet brought out. But that's very interesting of how things are going. The other thing, Mike, you mentioned about was, the European countries require them to take a license and cannot onboard customers without the license. And even people who had all the KYC and everything else could not have, had to freeze the operations till they get the license. And there's one question specifically on similar lines. And the question they ask is from Prashant. He says, if you are setting up VC exchange, can there or could be one body set up later on which could say license is mandatory? Is it possible? The answer is yes, it is possible. It is exactly what was done in Europe, and most likely this is exactly what will happen in India, assuming India does not go for banning it again. Then they are most likely to set up a regulatory regime. If they set up a regulatory regime, they will come with a license, and they may come with a license which will say, if you don't get the license, then you have to cease your operations. Two kind of things will happen. One is that they will give some time for people to get a license, which is most likely the scenario. In some situations, they can grandfather some of the existing exchanges, which is unlikely, but one can always hope for. So that's something which answers your question. I will now go to some other questions with respect to crypto exchanges. One question, again, I think Prashant has asked, and Jaideep, maybe you can answer this. Can crypto exchanges also open account for foreigner and foreign nationals? And will there be any FEMA-FERA complications? Jaideep, you may want to just touch upon this.
So as Vaibhav had hinted in the beginning, the reason we advise that participants on the exchange be domestic is that the RBI circular, which has been set aside, was not specifically issued under FEMA, and so the judgment doesn't quite have any direct bearing on FEMA. So to that extent, all the gray areas which existed under FEMA, which is our foreign exchange law, even prior to the RBI circular and prior to the judgment, most of them still continue. And therefore, when one carries out cross-border transactions, the question arises as to whether they're going to be treated as capital account transactions, current account transactions, export and import of goods. Do they amount to goods in light of the new observations by the Supreme Court? And FEMA always comes with filings, reportings, and other compliances which are to be closely done in association with the authorized dealer banks. And the way that crypto transactions are operationalized, it does not lend itself easily to, for instance, I send a Bitcoin abroad, file an export reporting the way one would do, say, if they exported software. So the entire modality of the current FEMA reporting scheme, as well as the classification and the categories under FEMA, do not lend themselves easily at all to the crypto market. And given the RBI's risk-averse view of the sector, that's the reason we advise that transactions be domestic. And most of the exchanges, the leading exchanges, are keeping the transactions domestic.
Thank you, Jaideep. There is a question from Abhishek Gupta, which says, if we could start exchange with foreign party who has established exchange and wants to enter India with our support. I think if this is a question, the answer is yes. As I said, it may be possible. The key aspect really is that the question really is that, can they set up a company which is 100% owned subsidiary and set up an exchange? Answer is yes. Can they set up a joint venture, which is a joint venture between themselves and an Indian party? The answer is yes. What kind of, how you will do the trading becomes again a question. Jaideep already mentioned about the domestic to domestic, which means that if it's a non-Indian to non-Indian, it can be done outside India. If it's Indian to Indian, it should be done within India. Cross-border is a question and a lot more complicated, and I think at this point of time we recommend to be avoidable. If there is a need otherwise, then we can discuss this offline, because there are very limited windows in what you can actually do. It's not that they're completely bad, but there are limited windows when it can happen. So this, I hope, answers your question, Abhishek. There is another question on by Anurag. Jaideep, maybe you can answer this. Does cryptocurrency classify as securities or commodities? And I know we are not dealt with ICOs and token issuance, and there is a specific reason why we are not dealt with that in this session. That's a separate session we can consider. And there are a lot of questions on that ground, so we will possibly not address that in this session, considering we want to focus on virtual currency exchange right now. But maybe Jaideep, you can address the classification of securities or commodities, and maybe you can touch upon a little bit on the tokens if you can.
So in fact, even prior to the Supreme Court judgment, we had authored a submission, an independent submission as a law firm to the Government of India with a copy mark to other relevant authorities, that the way in which the government can regulate the sector is possibly not with, as Mike was alluding to, treating all cryptocurrencies in the same way. There are well over 2,000 crypto assets. And while they all come under the moniker of crypto assets, they each have differing properties. and the law treats each of those properties separately. So, in accordance with some of the foreign regulators' treatment, we had suggested a threefold classification: utility tokens, security tokens, and payment tokens. Security tokens would arise when a particular token meets the definition of a security under Indian law. So, an example of a country taking this approach is the US, the SEC, which is the securities regulator, which does a token by token analysis. They go one by one on each token and check if it meets the test of a security under US law, and thereafter impose the requirements under securities law accordingly. Now, SEBI so far has not taken that approach, but when we look at the variety of tokens available, the consensus is Bitcoin is not a security, but many other tokens may amount to security. For instance, the SEC has already found that certain tokens do amount to securities and can therefore only be traded on regulated securities exchanges. The other implication is, as soon as you're a security, you need to follow the requirements under Indian law for issuing a security. It may be a prospectus, it may be other requirements under the Companies Act, but all of those requirements trigger, especially if it amounts to a share under the Companies Act. I saw a question on whether ICOs are feasible or have been conducted in India. We're not aware of an Indian company which has successfully carried out an ICO, because ICOs are inherently cross-border. And as soon as you get into cross-border transactions, there is a FEMA trigger. There is also a SEBI trigger, but the FEMA trigger is possibly the bigger deal breaker, and that does not lend itself to an ICO as of now, or at least a cross-border ICO.
Just to add to what Jaideep said, that basically we have not seen any ICOs which have been done legally. I have seen a couple of ICOs which was done. In fact, they touted as the first ICO from India, token issuers from India for doing a charity kind of for doing a non-NGO work, right? And some individuals had started doing it. I don't know whether they were successful or not, but there were few at least supposed launches which has happened, but none of them are legally compliant. With this, let me go to Meyyappan and ask him a text question. There are a lot of text questions which have come in, but most of the text questions have come in before Maya finished his GST discussion. So we will not take those one, but the one which came later, since we believe Maya covered many of them in his discussion, but one which came later, which I want to take it up. This is a question on casual trading. Again.
So I think I remember the question that you're referring to.
The challenge that question in the list.
But I think the question was on relation to whether I had referred to casual traders and the trades being made by them possibly not being subject to GST. I think the question was on whether that would still be considered as in furtherance of business or not, and therefore taxable. So they wanted some additional clarity on that. So to explain again, so a taxable supply under GST law is defined as any supplies made in the furtherance or course of business, right? And now there are several judgments even under income tax law where they say that for something to qualify as a business expense, it has to be in the furtherance or course of business. Now, if we look at those case laws, there have been situations where a company is into manufacturing and then they sold off leftover cotton bales because they didn't use it or whatever. It wasn't even useful for their manufacturing process. It was a leftover byproduct or something. It was almost like waste scrap or metal that they were selling. Sure, when they sold it, there was some income that came out of it and some expenses were incurred. But the question was, is that something in the furtherance or course of business, court said no. It depends on what your primary business purpose is and whether it was your intention was to conduct a business undertaking those activities. So keeping those in mind, when somebody is doing when somebody is a casual, I won't even say trader, but let's say somebody has a software and they mine 1 Bitcoin, 2 Bitcoin. I mean, it used to be that in the past that's what happened. Now I don't think not many people can mine Bitcoins that way. But if you have Bitcoins that were mined and you are in the ownership of a few Bitcoins and you do it as a hobby or as a pastime, I think there is some scope to argue that it is not in furtherance of a business and it was not even made as an investment at that point in time several years back. So therefore, it's out of the GST. But it's increasingly an unlikely scenario. I think the players in the space are increasingly more sophisticated, and I think it's not a space where many people are there who are in it as a hobby. But although there could be a lot of people who are trading and buying it, I mean, I think before the ban came into place, it's possible that some of the people just had a Bitcoin or two that they owned, and whether those fall under this or not could still be an open question.
Thank you. We are over time by a minute, so we need to close. Before that, somebody asked what is our email ID if they want to contact us. I have just put in mine and Jaideep's email ID. Meyyappan, maybe you can put yours in. You can reach out to us separately. I'm sorry we could not address most of the questions in paucity of time, but we hope we covered broad areas. With this, Deanne, over to you, and thank you, participants. You have been a wonderful set of participants, fantastic questions, and we really appreciate your interest in this topic. And Mike, special thanks to you for joining in. Deanne, over to you.
I would completely agree with you, Weber, when you mentioned that it was an excellent discussion, along with wonderful questions coming from our participants. I'd like to thank Mike, Weber, Meyyappan, and Jaideep for an interesting discussion this evening. Our next session will be held tomorrow, Tuesday, April 14th at 1500 hours IST. We'll be talking about how to obtain funding for arbitrations in India. This will be followed by 1800 hours IST, keeping the corporate wheels churning during COVID-19, hits and misses of the corporate compliances. And lastly, tomorrow night, we have at 2100 hours M&A case study. What are the legal and tax issues in brand acquisition deals? Everyone can register on our website or through LinkedIn. Thank you for joining us today. You may now disconnect your lines.